Good morning. This is Arlan Suderman, Chief Commodities Economist at StoneX. It's a little before 9 a.m. on this Thursday, October the 16th. It is the 16th day of the partial government shutdown. That matches the shutdown in October of 2013 when the October WASDE report was canceled. USDA has not yet officially canceled it, but I fully expect it to do so. And so that leaves us in the dark as far as USDA's sampling and what they determine the crop size is at this point until the November report, if in fact that's what they end up doing, which is what I expect. Now, in the meantime, let's take a look at the news headlines that are driving this market. And it continues to be the back and forth between the United States and China. Everything was heated up considerably when we saw last Thursday that China uh, added to restrictions to limit and to basically halt exports of rare earth minerals and magnets starting in November to countries around the world. That was a significant step for them. They had already been limiting them, and they tightened down even further on that. Why do so at this point? Well, first of all, we got to talk about the significance of those rare earth minerals and magnets. Those are essential for our high-tech electronic economy that we have in the world right now for the production and sale of not only cell phones, but automobiles, vehicles, airplane engines, uh, military radars, and most importantly for national defense would be defense weapons. So China has, as I explained in the previous video, China has been slowly, over the last 30 years, this goes back several decades, been slowly behind the scenes garnering a monopoly over the world's supply of processed rare earth minerals and magnets to the point where they now control 90% of them. That makes it very difficult for major industry to be able to produce what keeps our economy going, and not just ours, because they'd been limiting these for much of the rest of the West as well, for their economies to go as well without the imports of these rare earth minerals and magnets. But it also means that militaries around the world were unable to produce today's high-tech defense weapons without the supply of rare earth minerals and magnets. And so I come back to the question, why now? Well, last week, ahead of China making this decision, President Trump's administration moved forward with investing in at least 5 companies, mining companies, to encourage the mining and processing of rare earth minerals and magnets. These companies operating in Greenland and United States. First and second of all, you remember during the pandemic when the government wanted to have a vaccine for citizens to be vaccinated against COVID, they put into place a warp speed policy that would kind of pave the way through the permitting process and approval process to get what typically would take years to only take months. And so if you look at the permitting requirements for a company to mine and process rare earth minerals in the United States, the average is 25 years. There's only one other country in the world that takes longer to allow a company to mine and to process minerals. And so he wanted to shorten that from 25 years down to months to go through all the permitting process, the regulatory process, but to do it in an expedited fashion. So China saw that its window of opportunity to use this trump card, I'll call it, against the United States and against much of the rest of the world was a very narrow window. And so it proceeded then on Thursday of last week in order to play this card to make the restrictions. What we've learned since then is that the White House was caught totally off guard by this move. They knew that China had been limiting exports, had been in negotiations. We achieved a partial agreement for the flow of products last May for 6-month period. in the process of negotiating additional extensions to that. And then China came out with this export ban essentially on rare earth minerals and magnets. Now, when that happened, what's being reported from the White House now is that they reached out to China because China always says, let's not settle these things with tariffs. Let's settle this with talking and negotiation. So the White House reached out to China to talk about it, and they rebuffed their call, would not take their call about it. And that's been reported by state media within China as well. So things are certainly getting more tense. Now, previous negotiations this year between the United States and China have been quite respectful, and that's key in negotiating with China. They respond to respect. Negotiators even seem to be developing quite a friendly relationship, and that has changed now as well. U.S. Secretary of Treasury Bessent, who's been involved in some of these negotiations, described China's chief negotiator as, quote, slightly unhinged, unquote, and, quote, disrespectful, unquote, in stating that China's negotiator had threatened to, quote, unleash chaos on the global system, unquote, if the United States went ahead with its plans to charge port fees for Chinese built, owned, and operated ships, where Chinese policy had also garnered a monopolization of global trade. The bottom line is that relations between China and the United States have soured considerably after China applied the export restrictions on rare earth minerals. That notably decreases the chances of seeing a significant commodity trade deal in the near future, and specifically, it doesn't bode well for soybean export demand from the United States. And I'm going to talk about that here in a little bit. But first, I want to talk about China's economy because that's also a piece of this pie as we talk about the impact on the world, on particularly the United States and China. China's primary method of sustaining its economy has been to issue bonds that inject money into that economy, keeping life in it. But that also adds to government debt level. The Chinese government issued 11.46 trillion yuan, or $1.6 trillion of bonds, in the first 9 months of this year. That's up 60% from the same period last year. China's economy is largely relying on this government debt spending to keep its factories running and to keep consumer spending. Bond issuance, though, over the past couple of months, as debt levels have risen, has slowed, leading to concerns that we might see further headwinds for China's economy. That doesn't necessarily mean that China's economy is about to collapse, but it does suggest that the challenges facing President Xi are growing. He's willing to face those challenges rather than to yield to President Trump because he's playing the long game. He's willing to allow China to suffer in the short run to reach his goal of overcoming the United States so that he can reach his stated goal of having the top military and the top economy in the world. Controlling 90% of the processed rare earth minerals and magnets in the world was to become his ticket for doing so. That card that he is now playing in this high stakes game is what's front and center. And as I said, that drops soybean trade considerably down the list of priorities in these talks. Now, as we look at the impact, let's look at global world supplies of soybeans as a percent of carry out to use. That would be this brown line on this chart showing that it's at roughly about 17% or so and pretty level overall in recent years. As we've seen Brazil continue to increase production and the U.S. actually decrease the acreage that goes into soybeans, transferring market share from the United States to Brazil as China increasingly buys more soybeans from Brazil, but overall supplies are keeping up. There's no reason to rally world soybean prices right now to ration demand because supplies are quite adequate. And that's what we face. Domestically, it's a situation to where if we're going to increase exports of China, we're going to have to force them to do it with some type of a trade deal. that would require them to buy U.S. soybeans at certain designated volume, whether it was economically feasible for them to do so or not, but they'd have to get something in return for doing so. Maybe tariff-free access to U.S. consumer market or something like that. And if we were to get such a trade deal, con- combined with the strength of our biofuel program that it looks like, not guaranteed yet, but looks like we're going to have for 2026 and 27, it could be quite bullish for demand for soybeans. On the other hand, if China doesn't come back to the US market and we don't have fully built out the infrastructure for that domestic biofuel demand, then it could leave us with some burgeoning supplies here in the United States. Now, as we look at other commodities, for corn, for example, that's been a little bit different story. Look at these blue bars here, how they've been trending lower over the last decade. And so, and this is world supply of corn minus China, because China doesn't export soybeans, corn, or wheat in any notable volume at all. So, and they have massive supplies of most of those commodities. So if we look at it, world supplies have been trending lower, up higher this year, although we anticipate as USDA reopens and has a chance to assess this year's US crop, that will come down somewhat. But overall, we're looking at roughly a 9% stocks to use ratio. And so that means that's an adequate supply, but it's not much margin for error if something were to go wrong. Now, that's a big if. We don't know if that will happen, but that's what it's saying, that we're relatively hand to mouth in world corn supplies, even though we just or we're harvesting a bumper crop in the United States, although getting smaller, and a bumper crop, following a bumper crop in South America. When we look at wheat supplies, a little over 14% there, about 14.1 or 14.2%. When we look at world ending stocks as a percent of usage, when we take out the United States and China. Now, I explained why we took out China, because they don't export anything notable. Why take out the United States here? We know that we have a massive supply in the United States, so I'm looking at the rest of the rest of the world here to see what their supply is and when that might come short, bringing them back to the United States. Notice the longer term trend that we have here, going back since about 2008 or so, trending lower. So we do continue to trend lower there as well. Corn and wheat are interchangeable in much of the world, both of them trending lower. So we're moving in that direction. The bottom line is here, world supplies of soybeans are quite adequate right now. World supply of corn and wheat are trending lower over the last decade plus. They're still adequate to meet that demand, but we're trending weaker. That leaves us in a situation of low prices now. It leaves us in a difficult part of the ag cycle where we face low prices, and that could still extend for another year or two or three. We don't know that. But also, we would say that both corn and wheat are in a situation where if something unanticipated would happen to interrupt that production and or the trade of such, that it wouldn't take much to pull us out of that cycle, so to speak, into a better price cycle, so to speak, of demand for corn and wheat type of thing. So while we're in the bearish part of the ag cycle right now, that could change. We just don't have, and it wouldn't be that difficult to get it to change. We just don't have that triggering mechanism in place right now to do so. So this is Arlan Suderman. Be sure to like and subscribe if you want to continue to get these updates from the trading floor. Until then, I hope you have a pleasant trading day and stay safe with harvest.